Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman.
Today we're talking power purchase agreements. These long-term bilateral agreements have formed the basis of the renewables power market in Europe and the US. However, in this past year, as prices spike and volatility returns to power markets, they've become a significant source of risk for the utilities that have warehoused them over the last decade. What does the return of volatility and high power prices mean for the PPA? What does it mean for its evolution? What does it mean for the buyers and the sellers? And what does it mean for the renewable markets in general? Our guest is Werner Trabesinger. Werner is the head of quantitative products at Park and has a long background in structuring around PPAs at European utilities. Park is a software company enabling market players to sell, manage, and buy renewable power. As always, if you enjoyed the show, please do leave us a positive review, and I hope you enjoy the episode. Werner, thanks for joining us.
Thanks, Paul, for having me.
So we're talking about power purchase agreements, or PPAs, and their rise to prominence in the global, but certainly the renewable power markets. Before we dig into some of the historical context about how why they're so important and crucial to the renewables power market, could you just give us a quick definition of what a power purchase agreement is and what the facets in it are?
Sure. So essentially, it's a long-term bilaterally negotiated agreement to offtake energy. In our case, that will be electricity of renewable origin at a fixed price. That's what it is.
Right. So quite simple, but they've been around for a long time. It's a very simple structure and has been used by the power generation industry for a very long time, but they've become particularly relevant and crucial to the renewables market. I guess we're going to be talking here in the context of the European market, but certainly the same things have been going on here in North America. What is the historical background as it pertains to renewables and PPAs?
So in order to grasp why PPAs are so much of the essence for the build out of renewables, perhaps it's worth spending a few words on how renewables investment started off in Europe. So when everything started, the cost of technology was way above where renewables could compete with conventional sources of generation. So pretty much everything had to be government subsidized, meaning renewables would just sell their production into wholesale power markets and then receive a top up by the government to basically get them to the level of subsidy they were promised. As you can imagine, that leaves very little risk. So initially, mainly people were focused on technology risk. As for the cash flows, which would materialize, there was almost no uncertainty. So basically, the price at which energy was sold effectively was guaranteed constant by governments. And the only real source of uncertainty was fluctuation of quantities produced. But as you can imagine, if you look at 10, 15, 20 years, obviously that tends to average out. So in other words, in a subsidized regime, renewables churned out pretty much foreseeable constant streams of cash flows. And that meant that while everything was subsidized, you had pretty much the risk profile of a fixed income investment.
That enabled, and we'll come on to that enabled a very different set of power producer to arise because you were able to get non-recourse finance on the basis of these PPAs. Can we just dig in a little bit into exactly how that works? So the private equity group or whoever it was, the developer, would forward sell all of the power production to, would they sell that to who would they sell that to, and where did the government top-ups or the European Union top-ups come in?
So what happened back in those times was you would just go to a spot market. So sell your production as it occurred on a wholesale level, materializing some level of cash flow way below what you needed for the project to become viable. And the government would then go in hindsight and top up to the level which was promised under the subsidy.
Right. So there's no PPA here. This is just simply
There's no PPA. That is just taking your production to wholesale markets and then getting a top up at the end of the year.
right. Okay. And this is what time period are we talking here? This is 2010 or?
So this was from inception of these markets until, say, the mid 2010s, sometime around there. And from when the renewables business started up until, say, 2015 or so, obviously the cost of technology started to erode massively, meaning projects would get closer and closer to becoming standalone, economically viable. And that's when governments then started to introduce auctions where bidders showing or requiring the lowest level of subsidy would then be awarded the projects. So that started to move renewables closer to a merchant market situation, really. Come the second half of the 2010s, then especially in markets like Spain, the cost of technology had really dropped to the point where you could be standalone viable. The problem, though, is if you set up your project and you just take to spot markets to sell your energy, you're looking at pretty high levels of volatility. So typically, depending on the market, that's in the mid 10% range to 20 to 30% of annual price volatility. And compound that over a number of years, then obviously you have very low visibility on the cash flows of a project. So what then had to happen to enable projects is really for someone to step in and provide the level of price certainty which was previously guaranteed for by governments, and that's when PPAs emerged.
Perfect. Right. I've caught up. Okay. So you've got this. So we're late 2010s. You're now needing, renewable producers are facing the merchant markets without that governmental support. And in order to get that financing, you do need to be able to show the financier these contracts that prove the cash flows are there in the future. So take us beyond that point. Who starts offering these? Who are the buyers? Who are the sellers? How does that market start up?
So basically, how that started up is utilities and trading companies stepped in based on their core expertise of managing risk in traded commodity markets. They started offering long-term fixed price PPA contracts. So typically, you're looking at durations of 10 years, 15 years, sometimes even more. And given the fact that they have always been active in traded energy markets, what they do is, after contracting this long-term production from renewable energy projects, they take to traded markets to basically manage the price risk inherent in the whole structure. So in other words, if you will, PPAs are nothing other than a risk management service that utilities provide to sellers of renewable energy to the projects.
Yeah, and before we talk about the sellers, how roughly are these PPAs structured? I mean, is it a flat price? Is it linked to spot prices? What are the various pricing mechanisms that sat within those PPAs? Because I think that will become a crucial part of our later discussion.
Exactly. So they're pretty much all of them are fixed price, and typically, we said before that in the old times, when everything was subsidized, you would just deliver your production in whatever form or shape that occurred get a fixed price for it. And the exact economic equivalent of what you had back in subsidized markets is now called a pay-as-produced contract. So basically, if you contract your production under pay-as-produced, you will deliver to your utility or trading off-taker the exact hourly quantities that your asset produces and get remunerated at a fixed price. So in other words, you effect bar the volume risk, and as we said before, that's not a very large one, you effect a full transfer of risk onto the utility or trader.
Yeah. And that enabled as far as I understand it, that's good for the utility or the merchants because they've now got a power at a known rate that they can then trade around. And as you talk about offline, there's an informational imbalance there, so they're priding themselves on their capacity to get that power, I guess, ultimately cheaper, pay less than they would do in the open market for it. So that provides an opportunity to the merchants. That also is a significant service to the sellers, as you mentioned, because this again enables them to lock in future cash flows to get the financing. That created a whole new slew of renewable developers in Europe. Am I right in thinking that by the rise of these PPAs?
That is right. Yeah, basically, if you will, those contracts are essentially structured energy products where the off-taker provides a service of risk management to the seller, and they do that by trading in wholesale energy markets. So basically, what is important and what you have to understand is they are not really contracting that energy against some off-takes in their own consumption portfolio, but they merely swap out the energy to traded markets and try to keep the level of risk in their own books to a minimum. So in other words, they warehouse those contracts and continuously risk manage them. And that is what essentially enabled the build out of renewable capacity in markets which are merchant.
Yeah, which we will come on to why that trade might suddenly look a lot more risky than it did back then. But staying in the 10s to emphasize this point. So who did we see come into Europe and build? Because on previous episodes that we've done on European power, this was an era of incredible investment and even overbuilding of renewable assets, that led to very low prices for Europe for that whole decade, basically, in power. Can you talk about the scale of investment that went into wind and solar in Europe as a result of these PPAs being offered by the merchant utilities, the utilities there?
So basically, if you look back to the last 4 or 5 years, when we started tracking PPA transactions, publicly disclosed PPA transactions, we've seen, depending on which market you look at, compounded annual growth rates in the 20 to 30% range continuously. And obviously, there have been markets where in these initial phases, the build out was much more aggressive. So that would have been the Nordics, Sweden, Finland mainly, and Denmark for wind energy. And I think we'll get to that in a bit. Spain obviously has seen massive build out in solar capacity.
Just before we move on to some of the sort of inherent challenges and risks in this setup, were we also seeing at this point large corporates also buying PPAs? At least, I know there was obviously with regards to distributed generation, if there was stuff on site, they were. But what were the role of corporates at this point?
At this point, corporates were barely involved really in the business of procuring energy via PPAs. The reasons for that, and that to some extent, of course, applies also to independent power producers, is that it is inherently hard for them to assess PPA pricing. And the reason for that is that PPAs price off of wholesale market prices. So having said before that the whole business of being in the PPA space for utilities is nothing other than providing a risk management service, it is clear that also the pricing of PPAs is based off of wholesale energy prices. And now IPPs and also corporates have never been investing into capabilities of pricing structured wholesale energy contracts, because typically they've just procured, for the next year or very short term, and now stepping into the realm of much longer term procurement. And to understand how utilities price, you basically have to replicate their pricing technology, their analytics, and their risk management capability. And where this is not so easy for IPPs, it is even harder for most corporates.
Yes, yeah. So there are risks sat within these contracts, though, that as you point out, that the utilities are pricing in. They're offering this risk management service. Can you just help us understand what are the key risks before we get into the current setup of volatility and record price spikes? Just what are the key risks inherent in a PPA that people have to manage?
From a utility off-taker perspective, the service they provide is essentially what you would call in classic financial markets maturity transformation. So as they contract energy from projects for the next 10 or 15 years, as said, they take to traded markets to back out the risk from their books. And what you have to understand is that traded electricity markets have relatively small tenor ranges, which are liquidly transactable. So typically you can go 2 to 3 years into the future, but no further. So what they then do is they will sell the aggregate amount of energy they have contracted in the liquid space. And that leaves them with essentially a tenor imbalance where they're very short on the front end of the curve. And that will be absolutely crucial in understanding the current turmoil later. And that concentrated short-term, short position is meant to balance out the longer-term exposure of the PPA. And that leaves you vulnerable to moves of the forward price curve of electricity, which are non-parallel. So that's one risk they have to basically put up with and that they have to keep in their books. And secondly, where I said most contracts to date are still as produced, they have to live with the discrepancies between wholesale traded energy contracts and the random distribution of production across time, which they get from renewables. Because renewables are not programmable energy sources, they just produce more or less stochastically whenever the wind blows, whenever the sun shines. And that means that systematically in those hours where a lot of the production occurs, you will see prices a lot lower. And that is what is generally termed cannibalization. So what that is essentially it is an adverse correlation effect where the more you produce, the worse the price you get for it. And both of these risks, the price risk and the cannibalization risk, is what utilities just have to warehouse and keep in their books. So that's how basically for them, every PPA deal they do adds to the risk in their books.
Yeah. So the price risk being that you've got this, the tenor doesn't match to what you can hedge in the market, and it leaves you with this short-term short, if I've got it right, which is, as you say, is going to be crucial for the the exciting current happenings. And then you've got this cannibalization issue of, obviously, when the wind blows or the sun shines in Spain and the wind blows in the Nordic countries, power prices can drop precipitately because of the amount of production that happens. What about, as well, is there any risk around some of the governmental policies around these contracts, whether they're factoring in carbon prices, etc.? Is there anything there that also adds to the challenge of managing these contracts?
That is definitely the case. So if you went to look at Spain, where discussions were around taxes to be levied on electricity, or more recently, as prices started to spike, the government, started talking about owners of renewables making windfall gains, and then potentially considered intervening to take away some of these gains. That element of regulatory/political risk is, of course, there. Yes.
Yeah. So during this period, the 2010s, two questions. Firstly, did the tenor of these contracts remain around that decade mark, which is, interestingly enough, means I imagine a number of them are coming towards the end of their life. And secondly, in general, this was good business for both the buyers and the sellers. The utilities were, prices weren't volatile, prices were relatively low, the risk looks manageable. These helped them grow their balance sheets, their positions, and it was great business for the sellers as well. I mean, this was a pretty good time to be in the renewables, either risk managing it or producing the power during the 2010s, right?
Absolutely. I mean, you'd have economics of projects in Sweden, say, which really worked. So the sellers, once they had a PPA, were able to go forward with their projects. From an off-taker perspective, after the decline of record high electricity prices back in 2008, prices remained at a low but steady level. Volatilities were typically in the 8 to 10% range for a long time, which is really low. And that means that from a utility perspective, the risk in the book was very manageable. And that's why, those who were the early movers saw massive expansion of their business in the PPA space.
Yeah, and I mean, they were going around, hoovering these things up, right? I mean, it was good business. Okay, so, but then the last couple of years, so let's say 2019, 2020, things started to get a little bit more volatile. I say a little bit, much more volatile in power pricing. This is global, this is not just a European phenomenon, but we're talking here primarily about Europe. And again, I think all of this can be, to somewhat extent, analogous to what's going on in other countries. But suddenly the risk, starts to build in this, web of PPAs that have been built up over the last 2010s. Can you take us through 19 and 20 and kind of how that relates to this story?
Well, yeah, back in 19 and 20, the main market moving changes were really that the European Union came with much more aggressive decarbonization targets. The belief in the European emission trading system got more solid, and then as a consequence, EUA prices, so that's the European carbon contracts, came from the lows of €5 and started to pick up considerably. All of which, of course, is very positive for the renewable sector as a whole, because you saw firmer prices across the entire curve, more favorable economics of projects. But with that, gradually, one started to see that volatilities were really moving up from the lows. So where I said in the 2010s, you were looking at 8 to 10%. That started to be more like, 20 to 30% on the front end of the price curve, and in the mid-teens on the back end of the price curve. So gradually, risk crept back into markets. I don't think at this point it was perceived as a huge issue because it was pretty much a steady uptrend. But there was a feeling of risk coming back into the markets, and the slack in European demand, supply demand, which there had been in the mid 2010s, that started to really tighten up a lot because nukes got retired. A lot of you saw the onset of retirement of coal power plants and so forth.
Yeah, so you took all of this conventional off the system. We've got an episode coming up on nuclear power, and I didn't realize the extent to which that has shrunk in the. I think it's now just 10% of production. It's so you've got conventional power coming off. You've also got this new demand that you allude to as well. Is this where the corporates start coming in, who want to be able to buy renewable power to achieve their own goals around ESG, and so therefore furthering the price of these things?
Yeah, I mean, the onset of corporate demand was really seen as is commonly known with the likes of Amazon and Google data center firms mostly. And of course, they saw PPAs as an opportunity to really push their ESG credentials, but with a particular advantage that, of course, their share of cost of goods sold attributable to electricity is relatively low. So for them, price is certainly not something they would ignore, but it was not of the essence. And that's where you started to see them enter the game for PPAs, but not quite yet the more energy intensive industry. So basically heavy industry or chemicals companies back then were not really looking at PPAs, not quite yet.
Yeah. I haven't asked this, but were we seeing at any point during this period people selling PPAs to, are the utilities selling off this risk yet? Are portfolios of PPAs getting traded, or do they generally, for the most part, sit with the original buyer?
For the most part, they really sit with the original buyer, and they're risk managed in the way we discussed just before. Obviously, if there's an opportunity to sell down part of the book because you have someone looking for a 10-year base load supply contract, even though that is not the perfect structural match to what you have on the book, it will reduce your risk very efficiently. So there was constantly, of course, the origination departments of utilities trying to do that, but typically it has been more or less a one-way street where PPAs found their way into the books and then kept just being warehoused.
And are we talking, I mean, at this point, let's say, 2020, obviously we had the pandemic. And I think the real, I guess the kernel of this is that price risk you talked about earlier that sits with these utilities. They've got these short-term shorts. At this point, was there rising concern? I mean, did you have organizations reach out to you as Pexapart trying to understand whether they had correctly calculated the risks in their portfolio, or was this kind of like a sleeping giant, so to speak, at this point still?
If you look back at 2020, we have not seen a lot of these inquiries. So basically, if you replay what the market did back in 2020, you had say the first onset of COVID-19 back in late March, early April, where the market, well, as all of us probably remember, the oil market tanked briefly, and so did the electricity market. So basically prices came off very sharply, around 10% in 2 days, which is still a substantial price shock. Based on the fear that consumption would be, massively dented. But then people started to realize, okay, this is while the impact on demand was absolutely substantial, this is probably a transitory effect, and you shouldn't really discount prices, 10 years out. So in that sense, it was a little bit of a shock initially, but then the market started to look through, and for the remainder of 2020, prices were relatively stable still.
Okay, so 2021 comes along, and suddenly we've got incredible volatility, record pricing, and you tell me I can't remember the last bankruptcy count for power providers in even the UK alone. But can you frame up for us just how dramatic this story got this year?
Yeah, so if you look at, say, the German electricity market and the prices of base load for delivery in 2022, as it evolved in 2021, then January started off at well, at least judging from nowadays levels, very modest 50 euros a megawatt hour. The bigger picture in European energy commodity markets was that gas storages had been relatively drawn down in 2020. And so there was a lot of anticipated storage injections to come in summer to replenish the system for winter 21-22. And then gas didn't really come into Europe. So basically, firstly, you had lower than anticipated flows from Norway. You had very little LNG making its way into Europe because prices were more favorable in Asia. And the big hope was then pinned on the completion of the Nord Stream 2 project, where Russian gas would flow into Germany. And the approval of this project got delayed, in part due to regulatory constraints, in part due to geopolitical considerations. So then in the second half of 2021, also gas flows into Europe remain way below anticipation. And that means that now Europe is pretty much faced with not knowing if the gas we have is going to last us through winter, and it could very well be that in the event of particularly cold weather, we might see rolling blackouts in Europe. So all of this then gave rise to extremely escalating power prices, and from the lows of 50 back in January, the contract for delivery in 2022 traded up to beyond 300 euros a megawatt hour, so basically a six-fold increase. And that has never been seen before.
So phenomenal price spikes. I imagine with regards to our earlier comment about how the utilities have hedged these PPAs, that sounds like it could be quite painful. Can you talk us through what that price volatility and those price peaks mean for both for those who hold PPA contracts?
Yeah, so basically, had you not hedged your PPA contracts, as you said before, that would be an absolute boon to utilities. But they are very consistent in risk managing the books. So basically, they will strive to at all times keep their net energy position on the PPA books zero. So firstly, that wouldn't allow them to accrue very large gains. And then, as we said before, the structure of the books is such that you have these very concentrated short-term short positions to balance out the longer-term long position that you acquire via the PPA. And now, given a lot of these short positions, which are hedges, are concluded on energy exchanges, so they're therefore basically subject to daily margining, you have a very large short position at the moment where prices spike, And if you look at European electricity price forward curves, you see that they spiked particularly severely on the front end, which makes sense because that's where we have this scarcity of gas. So essentially, they are, as part of their risk management strategy, incurring very large cash outflows based on margin calls from the exchanges. And a few of the larger European utilities, in fact, had to take up loans to make these margin calls. And in a slightly different space, in gas trading, some of the risk management strategies are exactly of the same type. So also this short on the short end versus a long on the long end. And also some of the gas traders have had to put up amounts in excess of $1 billion to just cope with margin outflows.
Yeah. And what has this meant for the retail power providers? Because they're the ones, certainly in the UK, that have taken the brunt of this. I think, multiple bankruptcies. Are they also victims of this risk management around PPAs? And I don't want to say that you shouldn't risk management PPAs, but
Yeah, so basically with them, I think it has been, at least in part, a combination of not having as deep pockets as some of the major, commodity traders, firstly, and secondly, at least for some of them, risk management principles were too loose with a benefit of hindsight. So typically, what you've heard many of them say for a very long time, and that is coming out of the low volatility regime of the 2010s, is why should we really manage our position by entering into term contracts? Everyone knows term contracts are overpriced. Let's cover back our positions on the short end. So just literally buy on a day ahead basis whatever you need to deliver to your end customers. And that has obviously gone horribly wrong when you've seen this six-fold increase of prices, which you pay. Whereas on the other hand, typically a household customer is going to have a fixed price valid for at least a year. So basically they have seen cash outflows, which they were just not able to cope with.
yeah, it's the classic. There's no need for insurance when nothing's happened for a decade,
Exactly.
right? So, what has the so you've is this issue continuing right now? I mean, nothing has structurally changed. That means that the utilities aren't having to tackle these positions they have in the short term and the margin calls required. Have they restructured how they're risk managing these PPAs in their business? Like what has the reaction been? Because I can't imagine they can't keep having to post these margin calls in an environment where we expected to see these price spikes at least through the winter.
Well, I mean, most of them will certainly have deep enough pockets to get through the winter, no doubt. In terms of how you manage the risk of PPAs, I don't think there's much better than that you could potentially do. So while everything you contract is managed just on a wholesale trading level, they're doing as good as they can do. But what may change fundamentally is just the perception of risk, because as we said, in the lowly volatile period, business has been going very well. You have also not seen these humongous price spikes on the short end. So there was never, a substantial cash flow drain out of the activity. It is a very good margin business for them. So there was no reason to really challenge that. And now, out of the period of relative calm, you get into this nightmare situation where effectively the front end of the price curve completely detached from the back end. So I think it will leave a lot of them, it will lead a lot of them to really reconsider the level of risk aversion. So basically, if in the light of recent events, you're going to completely change your expectation of volatility for the next 10 years or so, that will have very obvious impacts on how you price PPAs, because you're certainly not going to contract them very aggressively. You would much rather say, well, for the 10 years in which we have to warehouse the exposure, we will have to put up with potentially a huge amount of risk. So we should really discount prices substantially to make this, a justifiable business.
Yeah, because you've described this as a watershed moment in the history of PPAs. Obviously, the pricing of them is going to go up. The balance of, or the understanding of the risk warehouse has changed. What else is going to happen? What's going to happen to tenor? What's going to happen to those corporates that have put their toe in the water to achieve their ESG goals? How do you see this market developing over the next 5 years as a consequence of what's happened in 2021 going into 2022?
So I think one market change that we should see occur is that volumes start to shift more and more to corporates. And the reason for that is, in my mind, pretty obvious, where in all of our discussions so far, we said whenever a utility signs a PPA, they put some level of risk onto their balance sheet, and that risk will not go away until the entire contract has gone through. If you're corporate, you will contract renewable energy with a totally different mindset. You will not go to take to traded markets to manage the risk, because you contract the energy against your natural demand, if you will. So that means you will not have to trade on an exchange to offset any risk. You just naturally offset risk. And because the PPA contract is a natural hedge to your short position, you also have an inherent advantage in terms of the price you can bid at, because where the utility will have to cautiously adjust prices to the downside to buffer risk, you could actually, as a corporate, take the stance and say, because every purchase of a PPA really lowers my risk, I might be willing to pay a little extra price. So in my mind, this will give corporates a real advantage over utilities going forward, because they don't have to warehouse risk.
But as you said, that's quite a challenge, and I guess this is where Pexapart comes in. But that's quite, it is no mean feat to be able to understand how to originate one of these things and how to structure and price it, and know that you're getting the right deal in place for your organization. How are corporates going to start understanding this space as they have to lean in more to achieve their objectives, and also it's starting to make sense with the utilities being less aggressive on pricing?
So basically what they will have to do, and that's pretty much our reason of being at Pexapart, is they will have to gear up in terms of analytics to really match utilities to be at a level playing field. So in other words, when you talk to projects to source PPA contracts, you have to be acutely aware of how utilities would assess the price of a PPA contract. Secondly, as you enter into negotiations, which will last a couple of months at least, you have to be able to continuously update your pricing in line with what the market does. And that's where we provide tools and advisory to help corporate off-takers price PPA contracts. And one other thing which you have to be aware of is that because PPAs are such an illiquid and such a bilaterally negotiated market, you will never see basically two contracts which are alike. So depending on who you talk to. There will be bespoke individual features, and that requires you to have an objective means of deciding which contract is the best for you to perform, let's call it like for like analysis, and saying, if I look at contract A, which has certain features, how can I translate that to a level of price which I can then compare with another contract? So there's a lot of analytics involved in really seeing through the pricing and seeing through the structural complexity of PPA markets.
Yeah. So finishing up, I imagine that it was a 10-year deal 10 years ago because that's what the NPV calculation required, and that gave everyone from the financier to the builder surety. Those contracts are now or starting to come off. What is happening to those contracts, and what does that tell us about PPA length, tenor going forwards?
I mean, in terms of tenors, which are traded in the PPA markets, definitely I could imagine that, given we are now at so much higher price levels than we were a year or 2 years ago, people might really move towards contracting production for much shorter periods of time, just putting in more equity and keeping exposure, where in the past you would typically hedge out 70 to 80% of your production for 10 years. I could imagine that now, at least in some markets, the preferential tenor will start to shorten, and potentially people will also start to use lower hedge ratios.
Yeah, just at a time, I assume, when the power providers are looking for more, looking for that more risk management products like PPAs, right? Given what you said. So you also talked there about these have remained and still are bilateral agreements bespoke to the conditions of the buyer and the seller. Do you see any increasing standardization in these contracts that would better enable people to offset the risk, sell on these contracts down the line, or do you think they will remain very much these kind of bespoke negotiated agreements?
Well, there have been efforts like 2 or 3 years ago by EFED, the European Federation of Energy Traders, to start to standardize contracts, but this has seen relatively low uptake, and I think there's multiple reasons for that. There's for example, the need to always look at credit in the contracts. That tends to be a very bespoke type of negotiation. Then we've seen other structures become more commonplace, like for example, embedded option structures in PPAs. So I think it may be, at least at this point, be too bilateral a market for people really to think of standardization, at least not quite yet.
Yeah. And finally, we're on the cusp of 2022 here as we record. What do you think holds for the PPA market next year? Is it going to be the same volatility, the same story continued? What's your sort of general sense for next year?
So certainly for next year, if you look at currently traded prices, the market sees that there will be substantial tightness in European energy in terms of how volatile the market might be. If you look to options on European electricity, indications are that next year will still be, at least in the longer term comparison, exceptionally volatile. And then probably once the geopolitical worries and the worries of Nord Stream 2 being completed fade away, we might return back to a calmer situation. But yeah.
Yeah, lots of uncertainty. Well, Werner, it's been a really interesting conversation. I've really appreciated you sort of taking us right through the arc of PPAs up to their very relevant context today. And we'll put a link to Pexapark in the show notes for people to go see your organization. And thank you very much for your time.
You're welcome. Thank you very much.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.